Robschild, no investment advice. Welcome to the show where we view the financial markets using Benjamin Graham's investment philosophy, macro technicals, and of course a touch of crystal ball gazing. Sorry for missing yesterday's show. I thought I had more time than I did. Today is Friday, April 11th, 2025. Today's episode begins with our headline, "The US dollar is America's Achilles heel, and it will be protected at all costs." Many people, including myself, are noticing that the dollar has been dropping recently. Many voices out there are worried about a potential de-dollarization, a change of global reserve currency. The way that I'm looking at it in the most simple terms are that the people that control the value of the dollar, being mainly the Federal Reserve, cannot and will not let the US dollar die. They won't let hyperinflation happen. They won't allow a new global reserve currency to take the place of the US dollar. It's not going to happen. And the consequences are likely to be very, very severe. Another way of looking at the dollar index right now, the way that I'm looking at it is sort of similar to a bond vigilante situation where it's a threat and, at the same time, it's what traders are doing on a day-to-day basis. I'm not sure we can claim that 2 days in a row of the dollar dropping by about 1% or 1.5% is enough of a reason to believe that the dollar is over. If we scroll out on this same chart, DXY, the dollar index, we can see that although dropping for 2 days and although lower than or at the very lowest point than it's been in over the past 2 or 3 years, we can see most of 2020 and 2021, the dollar was actually significantly lower than that. And scrolling out even further, the dollar relative to other currencies is actually, in my view, sort of still in the high range. I mean, look at from 2003 all the way up until 2015. That was a period of 12 years where the dollar index compared to other currencies was actually a lot lower. And then taking a serious look at the chart pattern here, if you are a chartist and you just take a look at this little pattern here, let's get the drawer tool. What is this? This is called a bull flag, and we're just at the bottom of this channel now here. If the dollar really is crashing here, we at least need to see these lows here taken out, which if we do go down there will be a lot of buying power here just on basic charting standpoints. And, are we headed down to the lowest level of 2009? I have my very strong doubts. In fact, I am of the belief that this may end up acting as a springboard for the dollar to continue much higher than anyone else expects. But that's just me and my crystal ball. Like I'm trying to say, though, the Federal Reserve won't allow the dollar to become a meaningless, third world country type of currency that can just completely hyperinflate into thin air. All of this talk about de-dollarization that you've probably been hearing about from a lot of other YouTubers and on TV and online and everywhere, I think it's all extremely overhyped. It's something to definitely continue to monitor and keep a close eye on, but I don't see this as a dire situation at this point. Next headline I want to bring up is the Consumer Sentiment Index extremely low. This is a survey put out by the University of Michigan, very famous. It has a long track record of pretty much seeing, is there some bad stuff coming because people are scared of spending money. The reading for March preliminary data, which it's going to be in the ballpark of the revised and the final version of this, it came out at 50.8. To visualize that from their own website, you can find it, umich.edu. The low level of consumer sentiment that this updated chart shows rivals with the very bottom of the great financial crisis. It's also getting closer to what was going on in 2022 when things were getting pretty hairy, and also in 1979, this area. We very rarely have consumers be looking at their situation and seeing things this bad. This is like, there's no way I'm spending money. I'm afraid that I don't have enough money to afford the things that I want and need. Just like Fred's style with the gray bars showing recessions, you can see that this dropping significantly has a pretty good track record of correlating with recessions. And being so much lower than almost all of the data in this chart suggests we may be headed into a very, very bad economic situation moving forward, which leads me to the third main agenda item of today. All paths lead to lower rates. We'll take a look at that chart in a moment, and it includes just a little piece of it, really. I want to bring up before we get there is the consumer price index coming out on Thursday and the producer price index coming out on Friday, both month over month being negative. This is actually deflation. This means that consumers in March paid less for their goods and services than they did in February, in consumers and producers. That's deflation month over month. Granted, the year over year is still above 2%, but this one little piece of data is not saying, yep, prices are just marching higher and higher. It's not happening that right now. I'll add to that piece in a moment. So this is how I see what's going on regarding the 10-year Treasury note yield, as I noted and many others noted after I think I was the first one to put this out there, honestly. I didn't get this from other people. I said it on my show on Wednesday, and it seems like everybody else said it later. Not that I have that many powerful people watching my show. Maybe I do, maybe I don't. But I said it's the 10-year note yield that is making Trump have to come out there and say, oh, we got to hit the pause button because this is not what we want. If you remember, he came out with Buffett saying, hey, we want to target actually the 10-year note yield. We want that to drop. And, normally tariffs would bring a rush to safety and bring that yield down. That would have been like, okay, we're doing it. We're bringing down the yields, the real, not real yields, the market's yields, the secondary market's yields, not what the Fed controls. It's the market that controls the 10-year note yield. And with it rising, that's like emergency. We have to pause this tariff idea. Anyway, just to go through the steps of why I think lower yields are coming very soon is because I see a 3-step process happening right now. We have had very recently, granted only several days of this happening, but we have a 10-year note yield rising. We also have credit spreads blowing up, which means debt of corporations is getting much more expensive. When you buy stuff from Walmart, some of their profits has to go to the bondholders, the people that have lent their money out and expect a certain interest payment. If that interest payment goes up because of rates going up generally on treasuries, but then credit spreads spreading, widening that even further, meaning that their interest payments looking forward are even greater than what anyone may have expected, leads to what's going on in step 2, and we'll get there in a second. I'm going to add the very low consumer demand. I mean, at this point, I see it as historic low consumer demand, as you just saw in that University of Michigan chart. 50.8 is like a dire kind of number, this is stating very confidently that consumers are not demanding lots of goods and services. They are closing their pocketbooks right now. Add to this tariffs potentially raising the prices of goods coming into the United States, making things even more expensive for consumers, potentially leading to further lower consumer demand. But we'll get to the step 2 in a second. And then the last part of step 1 is inflation contained. While you may be hearing on the news and other people talking about that markets are saying, oh, hey, this inflation thing, you guys in America, you don't have control of inflation, so we're not going to be buying your debt. Well, the CPI and PPI that just came out literally today and yesterday said that actually for month over month, we just went through a little blip of deflation. Add to this that the fact that the bond market of the United States itself has something called a Treasury inflation protected security. And what we do with that is we compare it to the regular 10-year note yield, and we get what the market is pricing inflation to average over the next 10 years. And during this entire time, has it been spiking since the tariffs were announced? No, it has actually been dropping. This is not saying that inflation is a worry in the bond market. That's not what's going on here. If this was going the other way, going higher and higher, then no, inflation is not contained, and there is an actual worry being priced into the bond market itself that inflation is going to be going up out of control. That's not what is happening here. So to review, step 1 happening right now, you have the 10-year note yield rising, you have credit spreads blowing up. On top of that, making corporate debt much more expensive. Add to this, we have very low consumer demand, historically low consumer demand. The sentiment of consumers right now looking to buy things in the future is extremely low. You have tariffs, potentially prices of things are going to go up even from here, even though things seemed too expensive to begin with. And then you have inflation contained, proved by the 10-year break-even inflation rate. So what's next? Step 2 in the future. This hasn't happened yet. We haven't seen it very clearly. This hasn't been in the news. This hasn't happened yet. We have the next step that will be a result of all of these things happening, especially if they continue in the same direction that they're going. We will have decreasing corporate earnings because this debt is going to get more expensive. The money that you pay for stuff, the profit, a lot more of that profit doesn't go to the company, doesn't go to the earnings, doesn't go to the value of the stock. It goes to the bondholders. And so you have that wealth effect dropping. People's stocks will be dropping as a result of this. All of this added up all together typically has rising employment. We already had the Somme rule trigger all the way back in June. We haven't seen another further increase, but I think that it is very, very highly likely right around the corner when companies have to figure out, hey, how are we going to make money? I mean, nobody wants anything. The costs of everything is higher. Even our debt is higher. The company can't make any money. We have to let go of employees, and that's how you get rising unemployment. All of this leads to credit spreads further spreading as the risk of people lending money to, let's say, Walmart becomes higher. It's like, oh, geez, we don't even know if you're going to be able to pay the bondholders the interest that you owe, and it rolls on itself in a very bad direction. So much so that we eventually get to step 3 further in the future, where expected future earnings drop further. So not only now at that point do you have earnings collapsing, but then an expectation of earnings continuing to go lower, which further increases unemployment rising further. And that's when you finally get the deflation phase and lower rates across the entire yield curve. But what do I know? I'm just a guy with a pet dragon and a crystal ball. There's a lot of really important things in the charts coming up. Before we get there, I want to bring up the community topics. What moves, if any, did you make today? This has been a great theme. I love all the interaction on the channel with hearing what you guys are doing with the moves that you're making or not making. Personally, today I happened to get some TLT calls. I can explain when we get to the TLT chart. I also got back into shorting gold after we had sort of a spike in gold. There's a trader named Gareth Soloway that I follow that went short gold here, and overall I'm bearish gold, so it seemed like a good opportunity. I got some in the after hours, which this short fund was actually lower than it was during the day, so if you're watching this video before 8 p.m. on Friday, it's still an opportunity, not advice. Don't ever take advice from a guy with a pet dragon and a crystal ball. Really bad idea. Second community topic. I had a commenter on, I think it was Wednesday's video that I quoted here, and I just wanted to share it with the whole community and comment on it. He mentioned, I say this as the owner of an import company, the tariffs are not paused. They're not even reduced. It is full steam ahead. They are just 100% gaslighting at this point, trying to convince the market that it is okay. So I'm not sure what's going on with that exact situation. My understanding from the news is at least that the 10% is actually now staying. I thought he said we were going to pause that too at one point, but now it sounds like from what I've seen more recently, it's staying. Comment in the comments below if you know anything else about this. But this person is saying that on top of the 10% tariff, I think this is what they're saying, the additional tariffs for the individual companies, countries, are still in play here. And if that's the case, well, holy heck. Black Monday. Maybe we'll have a Black Monday. Not really any major data coming out next week, although on a weekly basis, initial claims, if that starts spiking up, obviously that's something that can be noteworthy, but I'll only talk about next week things that are shocking or abnormal. The other coming up thing is still, I see a VIX opportunity ahead. If we ever get to that 80-90 range in the VIX, it seems like a really opportune place to actually short the VIX. As much as I think volatility is going to increase, it never stays, to infinity and beyond forever. And it seems like a great potential opportunity coming up. As it stands, the VIX looks like it's getting ready to go a lot higher. So stick around to hear about the charts. As always, thank you for watching, subscribing, commenting, and supporting. These are the daily reminders. Watch Macro Update 21125 to hear me explain most of them. And watch Portfolio Update 21125 to hear me explain most of my crystal ball readings. And Portfolio with minimal changes. I've been updating it a little bit, and I just changed this last section to 3 to 6% other. So with long-term holdings in a video game company, cannabis, and a grocery store chain, and a short-term, which I have SOXS and GDXD as it stands. If we look at our first chart of the day, SPX, the S&P 500. If we look at this chart by itself, it just looks like it wants to go sideways here. The larger structure looks pretty bearish, but the smaller structure from day to day says that pretty much anything can happen. However, looking at the pricing of options via the VIX index, this is extremely elevated. Anything above 20 is extremely high for the VIX. It's like the alarm bells are going off, and we're all still, although dropping recently, still very elevated. And if we take a look at this in sort of a pattern developing, it looks like a consolidation to me, waiting to break out. And the VIX, I have a lot of trouble with my crystal ball and all seeing the VIX explode to the downside. After all, it can only go so low. It really looks to me like we're setting up for the next leg higher. And with the S&P 500 not moving relatively largely compared to the current pricing of options index, tells me that I think more likely than not, Monday is going to be another one of these take no prisoners kind of sell-off days. TLT, my favorite place to be, even more so today, especially when it gets this cheap. I'm a little bit proud of myself for finding this gap fill here that I talked about during this entire time, basically ever since January, February. I've had this on my chart and I've been talking about getting to this gap fill. You don't normally jump over ghost area and not have a battle down there, and I'm just wondering if this is just traders seeing this. I mean, at the end of the day, everybody's a trader, right? Especially for anybody that's selling these as distressed assets, which they are. Most people, if anyone's selling treasury bonds right now, they're selling them at a loss. They are losing money by selling long duration treasury bonds with rates being higher. This much duration, TLT, by the way, apparently it has 16 years. I've been saying 24 years. 24 years is closer to what ZROZ has as far as effective duration goes. So the yield of this thing is between the 10-year and the 20-year, closer to the 20-year yield. That's how this is going to act. Any which way you look at it, on a day-to-day basis, markets are controlled by traders. As big or as small as the volume can get, it's still controlled by Mr. Market. And Mr. Market is a crazy guy. And this includes people in charge of large banks, institutions, countries, you name it. Everyone is a psychological being with their decisions. And so to ignore chart patterns completely, I think, is a little overly dismissive. After all, today we are now inside this gap fill area. Well, we were. Okay, so the closing basis, we were above it, but we poked our head down into it on Wednesday, and then we opened in the channel, went a little bit above it and closed higher than it. This counts to me as a gap fill. I kind of expect this to bounce around in this range before its next move, and I do suspect it'll go higher here. Otherwise, why would I buy calls on TLT today, which I did. Specifically for July 18th at 95 strike price. Cost basis 107. I will be selling this as soon as we get an explosive move to the upside in my direction. Everyone's talking about, including me, the 10-year Treasury note yield, and there's a number of things I want to talk about today. Just on a chart basis, it's no longer spiking up. The past 3 trading days have looked more sideways than anything, and with a pretty big topping tail, there's a chance that we get a direct reversal from here. But the main thing is that it's not going straight up. During the day, it tried, and it got beaten back down. This same chart, zooming out a little bit, we can see very clearly to the naked eye a head and shoulders pattern here within a channel. It would not be totally impossible to get back up to the previous high. That could end up being sort of a double top. As you can see, there's a lot of lines that kind of meet each other here. That acts as a big psychological level, and I don't think we'll get there. I'm suspecting that rates will be dropping as early as even just the very beginning of next week. It's just a guess, but the other main thing that I wanted to bring up for the 10-year Treasury note yield is in regard to a recent commenter talking about how they were surprised to see TLT dropping at the same time as TNX dropping on the same day. Normally, it would be the opposite. So it has to do, again, with the fact that the TNX, the 10-year, is not, it's not the exact upside down of TLT, because TLT has a duration of 16 years, not 10 years. And so it's a little closer when you get to look at the 20-year treasury bond. The 10-year, we like to use the 10-year for chart patterns just because it's a little bit more controlled. It's not going to be as wild as looking further out. Who knows, how yields should really be in 20 years or 30 years. Those are even more speculative than the 10-year. The 10-year is what everybody watches. So that's why when we just use the yield by itself, we're going to use that as a proxy for chart patterns. There has been a bit of a divergence between the 10-year and the 20-year. Specifically, for example, if we take a look at February 12th of 2025, we are actually lower in yields currently than we were then. Right now, we went down in yield. And from February 12th in the 20-year Treasury note, Treasury bond yield rather, we are higher in yield right now. So all it really means is that there's more selling or refusing to buy the 20-year than the 10-year. That's pretty much it. They generally move in sync with each other. And like I am continuing to try to explain, the 20-year and the 30-year are going to be a little more flip-floppy. It's harder to see that far into the future, which is why you can easily get these divergences. I bought puts on, no I didn't. I bought SOXS, the upside down of the semiconductor index SMH on Wednesday. This line is holding up. It's a very strong line. It represents the neckline of a Head and Shoulders top. The target on this is all the way down at 123. My target is 125. My exit plan is to sell about half of the position when we get to about 170, and then the rest of it when we get down to 125. The next set of charts help solidify my idea that the markets are very, very likely to continue absolutely dumping here, besides the fact that the VIX is expecting it. By the way, when options contracts pricing assumes a certain amount of movement in markets, typically the market does move that amount. You'll get tags on the ends of them, and so it's priced into the market right now that the price is not going to just wiggle around sideways like it did today on Friday. I found it really strange to not move so much today with the VIX staying this highly elevated. It screams to me that there is very, very big violent moves moving ahead. But adding to that, idea that it's probably to the downside is the fact that crude oil is not looking strong here at all, consolidating after dropping below a trend line going back 4 years, below $65 a barrel. We are setting ourselves up for an absolute tanking in crude oil prices. We see similar movement in HYG, high yield bond corporate. This is not looking strong. This is consolidating after violent moves to the downside, suggesting that there is more downside to go, perhaps violently as well. Dr. Copper appears to be building more than anything a bear flag here pretty clearly. And Dr. Copper has a PhD in economics. If the 10-year Treasury note yield must go higher, you would think it would go hand in hand with copper getting more expensive because everybody wants to buy cars and all this stuff. But with consumer sentiment crashing here, the charts all saying that things are still falling apart, it's pretty easy for me to see what's coming right now. I think buyers of gold are getting a little over optimistic here, especially because we're breaking out of a pretty long psychological channel just spiking to the upside. It would be very strange for it to just continue spiking. At the very least, we would get a pullback to the top of this previous channel, if not being a complete blow off top, especially if Treasury notes and Treasury bonds start looking more attractive. by the time we're done, have our brains settle a little bit over the weekend. I mean, this week it's been one of the craziest weeks of all time in markets. So this going down along with my TLT calls, it's sort of a reversion play, just getting a little bit back to normal, like, just popping the other way, even just for a day, and I can get out of those positions with a handsome reward. It seems the least volatile asset of all happens to be Bitcoin. Now, who would have seen that coming? That's insane. So the way I'm kind of looking at it, though, is that it's a insane battle here. While there are buyers of Bitcoin, there are sellers, and they are fighting to see who is right. This is a declining channel, which suggests that Bitcoin actually does want to break out to the upside. If it does break out strongly to the upside out of this channel, most chartists and people that understand how to read basic chart patterns will be expecting a much larger move up in Bitcoin. But we have not really seen strength coming to the upside out of this, not yet. I also have this line down here representing a 40% discount to the all-time highs. This is where I will be nibbling on Bitcoin myself. As much as I don't like it, I can't ignore it. The last chart of the day that surprised me quite a bit is the Fed funds futures now suddenly pricing only 3 cuts throughout all of 2025. For at least the past month, we've been expecting 4 cuts throughout 2025, but now we don't see that 4th cut priced into the Fed funds futures until March of 2026. I don't know what to think of this. I don't know what to think of a lot of things going on in markets that don't make any sense. Other than, it's Mr. Market, and Mr. Market's a crazy guy, and he'll do whatever he wants to do on a day-to-day basis. And at the end of the day, all markets are a voting machine, not a weighing machine. But what do I know? I'm just a guy with a crystal ball, and that's all from me and my crystal ball. I hope you enjoyed. Thank you for watching, and I'll see you next time. Robschild.